You are about to learn the two patterns that will make or break your trading success. If you want to dramatically increase your win rate, there's one thing you must master: being selective with your entries. And that starts with understanding structure. So today, I'm going to show you two patterns: one that consistently delivers high probability trades, and another that fakes out 90% of traders. Not because the higher time frame looked bad, but because the lower time frame structure wasn't clean. Let's get straight into it. Just because the 1 hour or the 4 hour shows a shift, it doesn't mean that you should blindly scale down and take the trade. If the lower time frame doesn't give you a structure that a 5-year-old could recognize, it's not it, guys. Period. First, let's talk about the pattern that you want to avoid. Here on the 1 hour time frame, we have pretty decent structure. Now, because I trade the two candle theory, I'm sure if you're watching this video, you would be interested in understanding more about the two candle theory concept. Then you would understand that this is a trade war opportunity. Here you can see on the 1 hour time frame, we have structure that clearly illustrates that we have a strong bearish candle close. Not only that, we can see that the previous candle had pushed bullish and we've closed with a wick rejection. This indicates to us that there's some pressure in the market from the bears and there is a chance that price can continue down. We have equal bodies, and we've spoken about this in our previous videos, where price is not broken above, we've traded below the previous price, and now we have a nice very bearish candle close. Not only that, we could look into this just a tad more. You can see that the structure on the 1 hour time frame is illustrating a structural high, a structural lower low, and now we have a structural lower high. So from a trend perspective, what we're anticipating is when we see the structure shifting on the 1 hour time frame, creating a lower high, then we anticipate a lower low. Now, once this candle closes bearish, the question we've got to ask ourselves is, did this candle close bearish enough to convince us that the next candle can be bearish? Well, the answer in this illustration or structure here is yes. We can clearly see that it's closed bearish enough. So once we take this information from the higher time frame, we then want to scale down to our lower time frame to see what the structure looks like. Now, please understand that this principle that I'm teaching you here right now is that not every higher time frame setup is worth trading on the lower time frame. Okay, so the 1 hour shift looks good, but let's scale down to the 5 minute time frame, which is our entry time frame in this example, to see what happens. Okay, so now we're on the 5 minute time frame. We understand from a high time frame perspective that there is a high probability that the next candle can continue bearish. Using scaling down techniques, what we're looking for here is clean structure to trade on the 5 minute time frame to continue to reinforce the idea that we can continue to move bearish. However, on this 5 minute time frame, we can see the structure is messy, it's unclear, there's no real higher highs or higher lows, or lower lows and lower highs. Now, this is where most traders get baited. The higher time frame break structure gives them a signal, but when you drop to the 5 minute time frame, the structure is all over the place. You see equal highs, you see random wicks, you see mini spikes to the upside and to the downside, and there's really no rhythm in price. Now, this is the kind of price action that leads to hesitation, right? Emotional entries and losses, because there's no framework, guys, nothing to guide your execution. And this is what we call noise-based trading. It looks like something is forming from a higher time frame perspective, but it never materializes. So let's take a look at this. We know from a high time frame perspective, the hourly candle has closed bearish. We understand that the higher time frame is illustrating to us that there is structure forming in terms of price creating a structural high, a low, a lower high, with the potential to now make a new lower low. So we've seen that. When we come over to the 5 minute time frame, we can say to ourselves, well, we know the candle has closed bearish. How do we trade this? Well, in theory, what we're looking for when it comes to the two candle theory is we're looking for price to break the structural low. We're looking for price to create a top wick, which is the anatomy of the candle formation. Once it creates a top wick and then flips bearish, we're then anticipating price to continue bearish. Now, whatever you go for is your prerogative, but here I'm just want to illustrate to you that the previous candle has indeed closed bearish. which simply means that what we're anticipating now is after this candle is closed bearish, the new candle will open, create a top wick, and then eventually flip bearish. So let's see how this plays out. It did indeed create its top wick, and as you can see here, it did continue down. However, as I mentioned already, there is no rhythm in the market. There is nothing here from a 5 minute perspective, a lower time frame perspective, from a structural pattern perspective, that the market is indeed bearish and going to continue bearish. Now, let's talk about the pattern that you want to trade. Here on the screen, you can see we're now looking at USD JPY again on the hourly time frame. Now, what I've decided to do is choose very similar higher time frame structures. And in fact, there is an argument that this structure is not actually bearish anymore. Short term, it shifted bullish because we have this clear trend to the downside. You can see that price has created a lower high. So this is an area in the market where you can see all these multiple wicks. So this is what we call a lower high and or resistance level in the market where price is failing to break. So when we see the pressure from the downside, what we anticipate the market to do is then create this pullback, lower high, and then look for that continuation down, which is a natural development of a trend. But what's happened instead is you can see that price has broken above. So now we have a shift in structure. So it's a little bit controversial from a higher time frame perspective, but remember, as a 2CT trader, we only trade single candles. So what we can see here is that this hourly candle has indeed closed bearish. Now, just because it's closed bearish is not enough information. We need to take our skills using scaling down techniques to lower time frames to look to see what happens. So if we just mark this area on the charts where this candle was closed and then scale down to the 5 minute time frame, we can see what's happening there. So here on the 5 minute time frame, you can see where we've marked the previous candle close, which is this information here. Now, comparable to the first illustration that we looked at on pound JPY, you can clearly see that there is structure forming on the 5 minute time frame. If we take a look at pound JPY, you can see the difference. Here in our first illustration, you can see that price is not creating structure. We have equal lows, wicks to the top, wicks to the body, indecision candles, and we have no real directional bias. If we take a look at USD JPY, on the other hand, you can clearly see here that price is illustrating clear structure. Firstly, we see on the 5 minute time frame that price was pushing bullish. Here is our higher lows mentioned. Once we create this area in the market where we have the wick rejections, what we anticipate here is price to create a higher low and continue bullish. But in actual fact, we have a shift in structure. You can see here price finally breaks the higher low. Now we have a structural high, lower high formation. And then to top this off, we also have a structural lower low. So in a downtrend, we look for a push phase, a pullback lower high, and then a lower low. And that's exactly what we can see happening over here. Now that we have this information, we can see that this is an A plus setup. The 1H confirms a shift and the 5 minute, but it paints a perfect story. You see clear lower highs and lower lows. You can see the shift. And then now, if we continue to see what happens with the new candle open, we will start to see the development of an A plus setup. So now we understand that the previous candle has indeed closed bearish, which looks like this. What we anticipate now is price to create a top wick, and then we look for the new candle to continue to push bearish and close bearish on the higher time frame. What we're looking for here is for price to continue to create the structure that resembles a downtrend, which is a structural high, lower low, lower high in anticipation of a new lower low. So here you can see that price is developing a clean pattern. Here is the shift, low, lower, high, break of the low, new lower low, and then now we have a continuation of this lower high here that has just developed on this new hourly candle. So for anybody that's new to the 2CT concept, this is what we call the creation of a wick. This is the anatomy of a candle formation, wick first, body next. And then what we anticipate is once the wick is formed, we then flip bearish to continue bearish. And as the illustration here on the 5 minute time frame, what we anticipate is price to continue down. So what we want to be doing is we want to be taking our trades on the break of the low. This is where we get the shift. This is where we get the flip on the higher time frame. And this is a clean pattern that you can be taking consistently that will deliver high probability trading setups. And as I've mentioned, this will deliver you A plus setups. And there you have it. Now, what happens, guys, when you take trades like this consistently, the patterns register in your brain instantly. So there's no humming, there's no hesitation. It's clean, it's structured, and it's precise. And this is what professional trading looks like. It's a playbook setup that you've seen time and time again, and you would take it without second guessing. Comparable to the illustration that we have on pound JPY, this is not clean structure. Comparable to the illustration that we have here on USD JPY, it is very clear structure. So this is why it's very important that you only want to be trading these patterns at all cost and avoiding these. Now, why does it matter? Well, being selective, guys, doesn't mean trading less. It just means being more disciplined. It means trading only when the story makes sense across the time frames. The higher time frames tells you what could happen, but the lower time frame tells you if it's actually happening. And then when both align, clean, structured, and clear, that's when you want to strike and take your trades. So you don't need more trades, you need better trades. If the structure doesn't scream at you, then don't trade. Wait for the lower highs, the higher lows, and let that story form. Wait for the structure to mirror clarity and not chaos. The 2CT model, guys, is built on one rule above all. Clarity wins, confusion costs. Stick to A plus setups, let the rest go, because your edge isn't just in what you trade, it's in what you walk away from. Make it happen, guys. If you enjoyed the video, do me a big favor, hit that like button so we can share it. Subscribe if you haven't, turn on notifications because we are going crazy this year. As I always say, guys, continue to trust the process.